Okay, welcome to another edition of the Care for My Wealth show, where we invest with confidence. How do we do that? Because we understand the machine. And something a little bit different today. You're accustomed to seeing my face, which was easily built for radio, not TV. But I have with us our head trader at Capstone Wealth Management and a host of other duties that are probably too long to list, and things along those lines. Clearly much better looking than me, Jonathan Stump. Jonathan, welcome to the show.
How's it going, Chris? You flatter me. Thank you.
It's good for everybody to be able to see you because, like the infamous Dr. Tuttle, who always does things behind the scenes, that is you. You do so much behind the scenes that most people just don't have an inclination of how it all works. So, nevertheless, I wanted us to start doing these podcasts, videos, whatever we're doing together so that everybody can just get a glimpse into some of the depth that we go through day over day, week over week, month over month, in an attempt to try and risk manage markets and deal with just some of the oddities that keep showing up inside the machine's structure. And as you know, when you hear me say the machine structure, I'm just simply talking about markets and their function, or in some cases, dysfunction. So with that said, what do you think of that jobs number that came, that revision that came out today?
Yeah, you got one job and it's supposed to come out at 10 Eastern, comes out at 10:35 and 818,000 less revised, I think it was for March. So that's the highest downward revision in history for those keeping tabs.
In history. I didn't know it was the most in history. Okay.
So it's a little disconcerting. We hear chatter, we follow different news publications, research. That's always been the issue, right? That the numbers have been overstated or whatnot, and the actual jobless claims have always been revised higher. Um, haven't seen any real significant impact to markets. I think that today they might have dipped a little bit when the report came out, but flying back high again, just shrug it right off.
Well, and that's the key. I mean, obviously there's all sorts of news and information that gets rolled out, data that gets rolled out day after day after day after day. And much of it just doesn't have that big of an effect on markets that people would think that it would. And then the things that you wouldn't think have any effect at all of a sudden affect it a lot.
Yeah. Well, it's really counterintuitive, right? Good news is
Right.
bad, bad news is good. It's hard to parse these different conflicting signals and data we continue to get. So it's why it's helpful to have some, on your side who's able to go through all of these very, the minutia and have a feel, because it can worry you if you're the one handling your money and you don't have somebody who's in the trenches day by day looking at all these, these tapes, et cetera.
Well, and I think that's one of the things that I've tried to express to people over the years is that if your attempt is to attack the market without some form of systematic approach and without some form of understanding how the machine views the market, because there's so much that's controlled by options flow these days. And I know that you do an incredible amount of work in the options markets and understand some of those flows certainly better than most. And one of the advents that we've seen over the last couple of years is just the extent and the amount that is flowing through the options market, much of which is designed to expire the same day, which is crazy in itself.
Yeah.
But are you seeing anything lately that's just really out of kilter? There's something that looks odd to you. I'm not seeing anything that's just jumping out at me like, oh man, this is really messed up. But maybe, are
Well,
you
I
seeing
mean,
it?
if anybody's been paying attention to markets recently, I guess complacency was the right is a good word to use, but it
Yep.
didn't take much. We can call it the carry trade with the yen, some of the data that came in on the employment, et cetera. But if we get into these positions and through the lens of the options market, we're able to see these different levels, specifically to the S&P 500, because that's the most widely benchmarked index in the world, and kind of gives you a gauge as to where to expect the S&P 500 to be in the range, because we don't necessarily trade options in our
Right.
client portfolios, but it gives
Right.
us, a schematic to see, if this happens, if there is a spike in fear, which we did, there's certain levels in the index represented by options exposure that can give us a sense of support, resistance, and that's kind of what we're seeing today. 5,600 is a big number. 5,650 is a big number for S&P 500, and that's determined by options positioning, not necessarily by individuals, but by institutions, because they are almost always going to be on the other end of the options. It's a zero-sum game. One wins, one loses. So being able to see and read and understand through the lens of the option markets gives us a good feel for how far down or how far up we're potentially going to go in the near term.
Right, right. And just so everybody maybe understands a little bit better, when we say complacency, how do we know that? It's just a function of what kind of protection has been bought or put in place in the market. And if not a lot, you have a fairly unhedged market. There's a lot of complacency that comes with that. And that tends to not work out well for bullish positions in the very, very, very short term. But, and I'm seeing complacency, like you said, really, really kind of ramp up over the last couple of days. But that doesn't necessarily mean Armageddon right out of the chute either. That can wash out pretty quick, right?
Oh yeah, and I would say that the conditions have normalized significantly since we've had that nasty couple weeks, 2-3 weeks, and that's been reflected. We're into what referred to as a positive gamma market right now,
Right.
meaning that the pain trade, the most likely thing is probably a grind higher, but that volatility we saw, the past few weeks was negative gamma territory, where the dispersion of returns is significantly increased, and that's when you can just see things shooting all over the place. And the VIX got to what, 60 something, 65?
65 pre-market. It didn't open up there. It opened up much, much lower, and for cash trading when the S&P opened up. But
Just for reference,
nevertheless, pre-market's
been since 2020 with the COVID.
right.
And we know how quickly that resolved itself. Now this is due to different issues, but VIX levels that high either mean one of two things: 08, 2000, 2001, or COVID, or we just had that temporary spike in vol, which is a beta. I'm not sure what the VIX is trading at now, but it's down well below 20 now.
It is. VIX is sitting at 1660. And, that's one of the things, as you know, I send an email out to everybody every single day. If you happen to be listening to this video for the first time and you're not a client and you'd like to see what it might feel like to be one, you can shoot us an email, info@careformywealth.com, info@careformywealth.com, and I can put you on our list temporarily so you can get a feel for it. But I send an email every single day that U.S. markets are open with a perspective of what I just view as the most important things that are on my mind. Something that's tickling my fancy that day that I think is probably something that we should at least recognize is happening. And those who get those emails every single day will know that I talk about the VIX a fair amount, just in terms of trying to help understand what's happening in terms of volatility. And the reason I do that is that the more we can understand the movement of volatility, the better we can understand why we take the steps that we do in terms of risk managing assets. And oftentimes I think, Jonathan, people forget the value of a strategy or strategies that are systematic in nature, that understand the flows of the market, identified by what's happening within options markets, that then allocate positions based on what kinds of movements are happening inside volatility space.
Right. I think you could agree that one of the biggest, one of the hardest things to get over is emotional. Humans are very emotional by nature. So when you invest emotionally, things almost always go the wrong way, whether you're selling at the bottom or you're buying at the top. You're fear of missing out, or so having a systematic, objective, as much as possible approach allows us to signal out that noise and focus on what are the market internals, what are they telling us, and a lot of times that's going to be 180 degrees different than what our gut, our emotional self is telling us, and that's what we're trying to avoid.
Yeah, amen. That's where that systematic approach comes in, like you've talked about. One of the things that I've talked about recently, as you know, within those emails, is that spike in VIX, and now obviously it fading itself out, gets to a point where it gets, well, a little bit oversold. And as you know, we employ a lot of different technical structures to help us understand the market's machine, and a lot of different systematic approaches to help us identify allocations so that we can move forward without emotion. And one of the things that I talked about recently was that the calculus, the rate of change of price, volume, and volatility for volatility itself had kind of got to a point where it looked like it had exhausted itself, and it may want to start to move itself back up. Usually, when we see that happen, we see markets start to get wobbly or maybe even sell off. But yet, maybe we're in a different time structure right now where when we see VIX up, markets up, it's not necessarily something that says, oh, Armageddon's coming, because VIX is still in a bearish trend. And when you say trend, again, I'm specifically speaking for those of you who haven't heard or aren't sick of me saying it yet. When I say trend, I'm specifically talking about the rate of change of price, volume, and volatility of something with a time series of more than 3 months. And we're doing that just simply so that the machine that focuses on trend following, they'll pick up those signals and they'll start to chase stuff. And when they chase stuff, there's a lot of money that's rolling in the bin. And so it's really, really important to understand various forms of time series that causes certain strategies to chase. And I think, Jonathan, I think that's one of the things that has been so hard for people to grasp, because so many people think that, well, I'm just going to buy a great company or an index or whatever it might be, but I'm going to buy a great company that has nothing but amazing fundamentals and awesome cash flows and everything will be great. And this just isn't your grandpa's market anymore.
No, and it's, I think a great example is just the volatility we saw. You can ask anybody off the street what's a great company stock to own. You're gonna, a lot of people say Nvidia, Apple, Microsoft. I tend to agree; those are great companies, but they were not spared in this vol bout that we had, volatility. So what happens is when the VIX spikes, volatility increases, the correlation between these constituents of the S&P 500 increases significantly. So that means that everything's moving together one way or the other. And so even if, like you said, great company, just buy a stock and sit on it, well, market doesn't care when we start getting into that elevated vol territory. It punishes everybody. So being able to identify those and attempt to get in closer to the bottom, out near the top, without having favorites or picking companies and having that bias, in the long term is going to pay off.
Yeah. Yeah. Agreed. So some of the things that we try to focus on, as you know, is the macro picture. What's happening with the global scale of macro, not just here in the US, but globally speaking. What's happening with monetary policy? Are they driving funds into the system or are they siphoning them out? What's happening inside the internals of markets themselves? And so it's kind of a stepped approach that we attempt to take that then help us to identify the best way in which to attack a market. And when you look at the macro cycle right now, I know a lot of people are sitting back and saying, oh, the market's just fine. There's no such thing as a recession. It's never going to come. And I get it. I mean, there have been people who have been saying recession for the past 3 years and clearly has not come. And the drumbeat was really, really, really loud on that last year. And I think the data was super supportive of recessionary conditions in many instances too. But yet markets didn't care. Markets completely ignored all of that and continued to march themselves forward, which again, I think utilizing a systematic approach that we've readjusted. Everyone that's a client that is with us right now knows that we've made some major adjustments to how we view portfolios and how we structure them based on different forms of machine learning. And again, understanding how the system is functioning with flows. And that's been working just fine. I think that's been working really well for clients, and they've seen some positive results within the confines of a very weird environment.
Yeah.
Like you said at the beginning of the show, we got an 818,000 adjustment to the jobs number that's come out over the past year. We can figure out AI, quantum physics, quantum mechanics, but we can't count jobs or elections.
One job, right? Yeah.
What's going on?
Going back to what you said too about forecasting recession or whatever it is, hard landing, soft landing. One of my favorite economists is not Navalier, Yardini, Ed Yardini. And I love his analysis because he's not in the camp where he calls one or the other. He takes the data as it is. And because that's really the best you can do. At some point, all these calling for a recession, soft landing, hard landing, they're going to be right.
Right.
But that's with a huge timeline. So by just judging, just like what Chris was saying, and systematic, objective on what we have, and not trying to pontificate on, be that person who called whatever it is, be like Michael Burry called it '08. That's not our job. Our job is to manage the risk based on what we see and what the numbers are saying.
Right. And interestingly enough, I have pointed out in the last couple of mornings in the email that there's, as always, a little bit of conflicting evidence that shows up from time to time. And one of the pieces that has just started to get interesting to me is copper. And the reason copper is interesting to me is it is, as you know, an indicator of demand. Our whole world is attempting to electrify itself, and so obviously the use of copper is a big deal. But copper's been completely blown to smithereens over the last couple of months. I mean, if you've been long of copper or owning the copper story, you've gotten hurt in a big way. And we've talked about that. We've talked about how the macro picture is in an environment where commodities tend to not do well. As you know, our systematic system sold us out of commodities over a month ago already. And those were the right moves. However, and I don't know if you're seeing anything different anywhere else, but one of the things that popped up for me was that the price of copper has over the last 4 days now been just slightly above what we refer to as that trade level. And trade is just, again, a calculus. It's rate of change of price, volume, and volatility of less than a month. And so why less than a month? Because momentum systems will pick up the signals of those things happening in markets for less than a month. And when that happens, it's the first indication that maybe something's different. Now, can that fall apart? Absolutely. It hasn't broken through trend yet, so it's still bearish trend. That's the major controller. But it's peeking its head above some levels that are, for me, making it look at this and saying, okay, have we gotten past maybe an interesting area where the demand isn't going to slow as badly as what people think? What do you think?
Well, copper's always been looked at as a great leading indicator for, I just say, growth going back decades. And is this time different? It's hard to say. Things are changing at such a rapid pace, and I think that China is one of the largest countries importers of copper,
Right.
and who knows what's going on over there. Talk about opaque markets. But to see it start to perk up a little bit after being so weak, I think from a very high level view is encouraging. Again, not getting into whether we're going to have a hard or soft landing or if we're going to global rebirth or slowdown, but that to continue to see copper sell off as it had and continue that trend would not be encouraging necessarily. But again, I'm always a little hesitant to compare things with today with anything before the computer age.
Yep.
But copper has been a resilient material, so there's always going to be demand for it. And like you said, electrifying everything, etc. And still pretty reliable. For that future demand outlook.
Yeah, 100%. And again, just not to beat a dead horse, but that's where that systematic processing comes in, because the money that the machine's pushing through the system will give you the first indication as to whether or not something's different. Right. I said a moment ago that we get some conflicting guidance. Well, compare what's happening in copper to comparing what's happening with, for example, oil. Oil keeps getting beaten up. It's getting pounded today down another 2.2%. Interest rates at the long end of the curve, 10-year treasury, 20-year treasury, so on and so forth, continue to drop. 10 years at 3.765% as we record this right now.
Yeah, and that's one of the things you had in your email this morning sent out to clients is the relationship with the dollar, right?
Right.
So with the dollar where it is and being so oversold, you mentioned that it's inversely correlated to bonds. Well, it's positively correlated to interest rates, right? So if it does increase to those levels that you pointed out, that would coincide with the 10-year, which is proxy for interest rates in the United States. It's going to be back over 4% again. And I think that'll be interesting to see how one of the biggest variables that we see is the housing market, right? We continue to talk about that as well. Right. And it's like, at what level do rates need to come down that feeds down into the 30, 15-year rates that makes housing more affordable? And if you find who can give you a good reasoning explanation for those levels, I'd love to talk to them. But these are some of the issues that, we look at every day. This is our job. Come in here, look at the numbers objectively as possible, and figure out the asset allocation. And but that'll be a variable to watch, I think, going forward here into the end of the year.
Yep, for sure. I'm with you 100%. Well, we're getting a little bit long. I don't like to have these videos, podcasts go too long because we all are in a generation of super short attention spans. Yeah. But I do want to do this. Let me give a few basic levels that could potentially be in play with respect to markets. And I'm just going to talk about the main market index that Jonathan pointed to earlier, and that was the S&P 500. And he's right, that 5,600 level on the S&P 500 is extremely, extremely important. The trade level, and again, rate of change of price, volume, and volatility over a period of less than a month for the S&P 500 is 5490. So 5490 is kind of that first area that if in fact we did get a bit of a pullback, I'd expect that to be the first level of support, defense, hold, however you want to look at it. Trend is right below it.
Too, like we mentioned this about the pullback and subsequent rally. What we're seeing right now is a V shape, right?
Yep.
Now I don't have the stats in front of me, but that's usually not the case. Usually what we see in these bottoming correction phases is more of a W. So puke, rally, back down, then we start making new highs. So we're getting back to where all-time highs for the SP 500. So it's going to be crucial to see if we break to new higher levels there, or if we do retest those lows, which Chris mentioned, we actually shift into negative gamma. So don't want to discourage people, but would not be surprised over the next 2-3 weeks, especially with the Fed meeting this weekend, Jackson Hole, Powell speaking Friday. There's a lot of variables. And then, of course, we have NVIDIA reporting next week, which millions of people will be paying attention to that. So
right. And to that point that you just made, our systematic processing programs, our systems that read the flows, have backed off of exposure to the S&P. I think for that reason, we've gotten this V-shaped bottom, if you will. The market's been up 9 of 11 days or 9 of 12 days or something like that. We're seeing volatility get pushed out of the market. And when I say volatility, it's a function of one of the indicators that we use on our systems. And I've shared some of these in previous videos. Future videos we'll do the same. But Jonathan's exactly right. If in fact we got a bit of a pullback, we'd want to be in a position to take advantage of that, which is one of the reasons why once the market broke trend and once the market really got into that deep gamma, which is where not to get too into the weeds, but that's essentially where when markets sell, dealers have to chase the sell. Volatility goes up in both directions, right? And so we saw some volatility turn upside, but yet for our more aggressive portfolios, we took the leverage off. And we did that to be prudent because when you get in that kind of a situation, it has a tendency to get really wacky really fast. And so in an attempt to try and protect where we were within the confines of this disinflationary growth slowing type of an economic cycle, both Jonathan and I talk every single day throughout the entirety of the day, coming to some conclusions of what we're seeing within the tape, what we're seeing within the volatility of the markets, what we're seeing within the systematic approach to allocations, to come to some conclusions of how much risk should we be taking here. And if, to Jonathan's point, we find ourselves in a scenario where we get another dip down and it makes a higher low, maybe within or above the current trend level for the S&P 500 right now is 5394, right? 5394. If we can stay above 5394, we're putting the leverage back on for our more aggressive accounts because that would be the spot that is really, really calling for an upside move. Unless Jonathan sees something and throws a baseball at me across the office and says, stop that. We're not going to do it.
Yeah. And like, so you mentioned that 5394, that lines up with these gamma levels through options, which we refer to as the put wall, which is big a concentration at certain price levels for the SP 500 that point to support on the bottom for the put wall and up above prices we call the call wall. So we have this range. Right now it's pretty wide, 5,400 up to 5,750. Like, and that makes us a little hesitant because that's due to the elevated vol out there. And like we said at the very beginning of the video, when the VIX, which is a representation of the volatility, S&P 500, reaches these really high levels, it's one of two things. It's either uh-oh, or it's just going to bounce right back higher most likely. But we want to avoid the uh-oh. So that's part of the reason we cut that exposure, because a lot of times Chris says is that selling begets selling, that prices will move lower, and tends being right. He has much more experience in this, but it's watching these things and viewing it again through the systematic lens that we attempt to use, and get rid of that noise, allows us to be prudent with the asset management, and really get out or get back in at the most pivotal points based on the data, because that changes every day. And again, like Chris said, we talk about it, we have our approach, and we stick to it.
Yeah, that's right. That's right. Okay, well, we're going to wrap up for today. Jonathan, thanks so much for joining us. And you're going to get to see more of him and more of me. So hopefully everybody will be excited to see more of this as we move forward. It's always hard to say how many of these we attempt to do within a week. The week goes by very, very fast, and sometimes gets very, very long in the tooth in terms of just doing the day-to-day bean counting that is required of what we do every day. So if you have any questions, I am, trust me, I am the world's worst mind reader, and I have been told that by more than a few, especially my family. And so if you have questions or comments, or if you just want to chat, let me know. Send us an email. Mine is chris@careformywealth.com. If you want to chat with Jonathan directly, you can do that. It's jonathan@careformywealth.com. If you want to set up a time for us to meet and get together, 866-596-9886, or an email, either would be fine. And we're happy to do that. We're happy to answer whatever questions are on your mind, and keep us moving in the right direction. So with that said, we'll see what the whole Jackson Hole thing has to say, and Fed Powell and the powwow of Fed heads that are out in Jackson Hole, Wyoming right now. Wish I was there. I love Jackson Hole, Wyoming. It's beautiful.
Beautiful.
It is. It's beautiful. All right, cool. Thanks so much. Appreciate it. And everybody, we'll see you next time.